Welcome to the TMC Partner Webinar featuring James Brody of Brody Gap LLP. I know James has a lot of really great content to share with you today, but before we begin, this session is being recorded. A copy of the recording and presentation will be shared with everyone after the session. So please feel free to drop your questions in the chat. And James is going to aim to answer any of the questions that he can at the end. And if we're not able to answer your question during the session, he'll provide a follow-up FAQ within a week to address anything that we have missed. So with that said, I'm going to turn this over to you, James.
All right. Well, listen, thank you very much, Mimi. Welcome, everyone. I'm happy to be here giving this webinar. And I'm going to go ahead and turn off my video camera so that I can have the entire PowerPoint up. And what you'll see is a lot of information that, there's no way that we'll be able to make it through in a high level of detail, but you will have the documentation so that after the webinar, you'll have a fulsome packet. And then if you have any questions, as Mimi said, go ahead, send those in, and we will prepare that follow-up FAQ so that you can have all of your questions answered. So with that, I will go ahead and get this turned off. And then, all right, hopefully everyone can go ahead and see that title slide. Listen, for over 20 years, I have dedicated my career to representing mortgage companies in complex litigation, regulatory matters, and the experience ranges from defending repurchase and make-whole demands to guiding clients through compliance challenges and agency audits. We had just founded Brody Gap, really, and assembled a team with industry expertise so that we can help all of our clients navigate the uncertainty and move forward with confidence, which in this particular era is needed more than ever. So with that, I'll go ahead and provide the standard proviso that nothing presented today will constitute legal advice, nor does it create an attorney-client relationship between any of the participants. Now, as for Brody Gap, we are a national law firm with roots in the mortgage banking industry. We specialize in helping lenders, brokers, credit unions, servicers navigate, the full spectrum of legal and compliance challenges. Our expertise spans from defending repurchase and indemnification claims to managing CFPB and state regulatory audits, addressing employment and trade secret matters, and advising on loan office compensation, MSAs, licensing, mergers, and much more, much of which we will actually be talking about today. All right. Now, I want to go ahead, Mimi, and turn this over to you because I would love for you to be able to go ahead and talk a little bit about TMC, and which we have been involved with and part of since its inception. And we're really happy to be partnering with them with this webinar and many more.
Thanks, James. Hi, everyone. I'm Mimi Paxson, and I lead our strategic partnership at the Mortgage Collaborative. For those of you who are not familiar with TMC, we are a cooperative with over 200 lenders, including independent mortgage bankers, banks, and credit unions. TMC represents about 10% of the total mortgage volume in U.S., and we are managed by our founders, industry icon John Robbins, David Kittle, and Jim Park, along with our president and CEO, Jody Hall. So the mission of TMC is to foster a collaborative and innovative environment that empowers our member to grow, thrive, positively impact the companies and communities that they serve. Our members share ideas, best practices. They solve challenges and build lasting relationships through our conferences, working groups, collab labs, roundtables, and like benchmarking tools. We also offer exclusive access to best-in-class network of partners who, provide trusted expertise across the mortgage ecosystem, from origination and compliance to technology and so forth. Now, James has been a longtime partner of TMC, and as a benefit to our TMC members, he offers 10% savings off his standard fees. He also offers 2 complimentary 30-minute consultation per year upon request. I've included my contact information here and would love to connect if you'd like to learn more about our member benefits and how TMC can support you and your organization. With that said, I'm going to turn this back over to James. Thanks.
All right. Listen, thank you very much, Mimi. So just kind of starting off, looking at the agenda, listen, during boom times, it was easier for the companies to invest in compliance. And now facing yet what may be a downturn, because I think a lot of people are kind of confused here. What usually happens is people are forced to cut costs, often at the expense of the compliance side. And that's usually because they are reducing staff or accepting more regulatory risk. Now, if someone says to me, "Hey, listen, James, it's great that of course we want to be compliant, but if we do this, we may go ahead and have to shut our doors." And it may be something where the fine may be somewhat low. So, while I never advise our clients to go ahead and not be compliant, there is an understanding that sometimes you have to do what you have to do if the ramification is going to keep you in business. That being said, I want to make it as easy as possible for our clients and the industry to find the ways that they can remain compliant, answer any questions about those gray areas. And, look, there's a lot going on. With loan officer compensation, there's a big question mark above that. What's going to be happening? But right now we also have the CFPB, who is effectively made impotent in many ways. And people are asking, well, if the CFPB is going away, maybe our risk is lessened. And while, that would be something easy to understand, the problem is that the states are really going to be going ahead and filling in the gap. And it's not just going to be blue states or red states. If you have to comply with a blue state, so to speak, well, you're going to have to comply with the red state too. If they see that you are only doing a partial remedy on certain matters, then that could be problematic in and of itself. So, on the one hand, there is a case to be made that the CFPB is actually, a good thing, because at least then you don't have this confusion. And when you have confusion, it's easy to run afoul of being compliant. But even with all that being said, what we do know is that when the pendulum swings one way, it tends to swing back the other way equally. And if it swings back equally to what it has done now, then we could be in big trouble, because the CFPB could come back with a vengeance, and they will be looking in hindsight. They're not going to accept any excuses that, hey, we didn't think it was going to be needed. All of that will be out the window. And so the best advice is to treat the CFPB as if it is in full force and effect, and to make sure that you are keeping your companies as compliant as possible. Now, the goal of this webinar is really to show how the industry can stay profitable without sacrificing compliance. History tells us that companies who trade the long-term sustainability for short-term gain often don't survive to benefit from the next boom. So today we're going to be covering key issues, including LO comp, data privacy, security in the age of AI, rising interest rates, and market volatility. We'll also explore MSAs, fair lending and UDAP, dual employment and conflicts of interest, and what's really ahead for the rest of 2025 and beyond. Now, the first issue we're going to start with is what I think is always on everyone's mind, because without compensation, we don't have businesses. And really, when it comes to loan officers, they are the widgets that are sold, because without them, again, there is no production. Without production, there is no business. All right. Now, the loan officer's biggest items. So some of the most prevalent compliance issues really are involving LO comp, and they revolve around steering borrowers towards higher cost loans, receiving remuneration based on loan terms, or engaging in dual compensation. In 2023 and 2024, several institutions incurred significant penalties for violations of the LO comp rule. Ensuring compliance necessitates the implementation of clear policies and rigorous monitoring procedures. Additionally, there have been reports indicating that the CFPB is reviewing certain regulations, including potential rescission of the LO comp rules. The implications of this review really remain uncertain, though, and in the absence of regulatory guidance, LO comp rules would revert to the original language under Dodd-Frank Act, which would not necessarily be a good thing. Now, under the Truth in Lending Act, or TILA, and the LO comp rule, lenders must ensure that compensation structures do not incentivize steering borrowers toward less favorable loan products. And as we know, the original LO comp rule went into effect in January of 2014. However, despite the fact that the rules have been in place for many years, some changes and evolution to the rule have taken place, and we continue to receive many inquiries about LO comp. Therefore, we want to make sure that we provide some additional information for you here. So looking at the first bullet, the rule prohibits a lender from compensating an LO based on the loan terms or a proxy of the loan terms other than the loan amount. Now, on the second bullet, when determining if a factor is a proxy for a loan or for a term of a transaction, there's really the two-part test. A factor is a proxy for a term of a transaction if the factor consistently varies with the term or terms of the transaction over multiple transactions, and the LO has the ability, either directly or indirectly, to add, drop, or change the factor when originating the transaction. Now, remember, this is a two-part test that a lot of people get wrong, and we have had matters where a client has come to us and said that they were told that one thing is compliant, one plan is compliant, but then if you actually look at that plan and you see how it's carried out, and not just on its face, but the impact, then that can also run afoul of this rule. And that's something that always needs to be tested against whenever you're doing an LO comp plan. Now, the rule also prohibits comp from both the consumer and another person, meaning the LO cannot receive a commission from both the borrower and the company, as an example. Now, the rule did provide 7 examples of what would not be considered a proxy of a loan term, which are reviewed quickly here. But of course, the Bureau indicated these 7 are not an exhaustive list. However, it's not a list. You should exercise, extreme caution, speak with your counsel, make sure that you are not going to get hit in the next audit. Now, the first bullet here, payment based on the LO's overall volume, either their total dollar amount of credit extended or total number of transactions originated during a specific time period, is permissible. Long-term performance of the originator's loans, hourly rate of pay to compensate the LO for actual hours worked. Now, keep in mind, it is acceptable and very common to pay a base rate for hours worked on top of a commission that's earned. Now, you can also look at whether the consumer is an existing customer of the creditor or a new customer. Paying a flat fee for every loan originated. Now, keep in mind, this can be tiered as well. For example, for 0 to 5 loans originated, the LO shall receive $200 per loan, and 6 to 10 loans originated, the LO shall receive $250 per loan, and so on. You can also look at the percentage of applications submitted that actually closed, and the quality of the LO's loan files, such as accuracy and completeness of the loan documents. And this piece also comes up when we are talking about various clawbacks, because when you have when you are looking at whether or not you can claw back, although there is a line that can be walked, one of the easiest things to do is to create quality metrics, which we have in a lot of our LO comp plans that we prepare for our clients, that can be forward moving, so that you're not overly concerned about whether or not something has been quote unquote earned. Now, I wanted to quickly go over some examples of popular permissible comp structures, but also structures we commonly come across that we recommend avoiding. And first, I'll go over the permissible structures. First off, one question we frequently get is whether we can pay our originators in the same state or the same branch different amounts. And the answer is yes. Some originators are better than the others, and the amount you pay to each may vary from one state to another, or even within the same branch. There is no requirement that you pay all your originators the same amount, simply that whatever you pay any given LO, that it complies with the LO comp rule. Now, keep in mind that if you are paying differently, amongst different LOs, there is always the chance that they will try to use that as a hook for some sort of discrimination claim. So while yes, you can look at the LO comp rule and not run afoul of it, no, that isn't the end of the overall analysis, because you have to think three-dimensional chess when it comes to these issues, and not just whether or not something is compliant with the LO comp rule, but how it may affect you in other realms of your business. Now, toggling between borrower and lender paid, we're asked a lot whether our clients can allow a broker to choose borrower paid comp on one transaction and then lender paid compensation on another transaction, within the same day or a month. And the answer again is yes. Your LO can toggle back and forth between borrower paid and lender broker paid from transaction to transaction. According to the rule and the commentary, the prohibition against dual comp is transaction specific. Of course, that being said, as a lender, you'll need to ensure that you have proper oversight of this. And we recommend once a transaction starts off one way, it remain that way. Plans that provide a minimum and maximum comp per transaction. You can set up plans that provide for a floor and a cap so long as the minimums and maximums do not vary with each transaction. For example, it's permissible to pay your LO 1.25% of the loan amount as comp, subject to a $1,000 minimum payment and a $5,500 maximum payment. Sign-on bonuses as well as initial guarantees. We often receive a question inquiring whether a newly hired LO can receive a sign-on bonus, or a question verifying an LO can receive a guarantee during a specific period of time. These are both permissible and actually quite common. Pick-up plan structures. In these instances, an LO is presented with multiple comp plans, and the LO can elect which plan they want to get paid on. This is permissible so long as none of the other plans presented to the LO independently violate the comp rule. And it's worth noting that if the plan affects the price to the consumer, as it generally does, you could have fair lending implications if the various LOs with different plans are in the same market. Now, as far as periodic plan changes, it's important to understand that you can modify your LO comp agreements. And but with that being said, it's our general recommendation that you don't change plans frequently. And for retail plans, we recommend not more than once every 6 or so months, but certainly no more frequently than quarterly. Also, it's important that any changes apply prospectively only, meaning the comp will apply only to applications taken on or after the date of change. And again, that could get you in terms of whether or not income has been earned. Lead source options is typically compliant if implemented uniformly and in a consistent manner. The most common way of doing this is to clearly identify and track the source of the lead at the very beginning. Additionally, the company should have clear policies regarding lead source and comp, and the source cannot be identified or associated with any loan terms or product. Now, that's the permissible side. Moving on to the non-permissible, varying compensation by loan products. Remember that the LO comp rule prohibits basing the loan officer's comp on a term of the loan. Terms include interest rate, APR, and qualifying credit score, amongst others. And a loan product is essentially a bundle of terms. So if you vary your LO's comp by loan product, it's possible you're basing the pricing on a few loan terms that make up the entire bundle of terms, which we call the loan product. Sliding scale percentages. When paying LO comp based on a percentage of the loan amount of specific transactions, the percentage must be fixed and cannot vary with the amount of credit extended. So for example, you can't pay an LO 1% for loan amounts more than $250,000, 1.5% for loans between $150,000 and $250,000, and 2.5% for loan amounts less than 150,000. Now, since lenders typically choose whether to sell or hold a loan based on the loan terms, for example, holding in portfolio 7-1 ARMs, but selling 30-year fixed loans, or holding in portfolio loans that are conventional, but selling loans that are FHA. Since the LO usually advises the borrower which type of loan to choose, this would be considered a proxy of a term of a transaction. In fact, this is a scenario used by the CFPB itself to illustrate what a proxy is. Compensation pools. Paying a bonus to an LO out of a bonus pool based on the lender's profits from all of its LOs is not permissible. In these situations, you're simply compensating the LO based on the terms of multiple transactions by multiple LOs. And this is another example the CFPB explicitly calls out as being prohibited. All right, now the gray areas. As we all know, not everything is cut and dry, black or white, and various gray areas do exist within the regulations, including within the LO comp rule. Now, I'm going to quickly discuss 4 practices which fall into that gray area. And these fall, the first 2 may be permissible, but we recommend exercising enhanced caution when implementing them. The first is varying compensation by state. While this is not expressly prohibited, it is possible that it could give rise to fair lending concerns or be a proxy for a term or transaction. For example, if you have a higher proportion of borrowers of a protected class in one state versus another, and LOs receive more comp at a cost to the consumers in those states, it could result in unintended fair lending violations. The second is reducing comp to cover fees such as rate lock extension fees or fee tolerance cures. While updates to the rule have clarified this is permissible, it's only permissible in very specific situations in which the change was a result of unforeseen changes. The burden of proof will be on the lender to demonstrate this, and as such, we always caution our clients on implementing these types of provisions. The next 2 examples are plan elements that are questionable and we recommend avoiding. The first is broker versus banked compensation. The rule does not explicitly address this, but it falls under the proxy analysis. The CFPB found that broker versus banked comp was a proxy of a loan term and therefore not compliant with the LO comp rules. The second is the EPO EPD. LO comp rules do not address this, and it is most likely not a violation of LO comp. However, there are states and federal wage laws where that you have to consider, especially when implementing any form of EPO EPD clawback. And so again, as I mentioned at the outset of this, what we often tell our clients if they want an easy rule of thumb is to not do the clawback, but that they can install quality metrics and take out that comp on a prospective forward-moving basis. But we do indeed have some types of clawbacks, whether it's seasoned loans here or not. All right, technology, data privacy, and data security, which is, besides LO comp, one of the biggest issues that we see in dealing with whether it's poaching, non-solicit, or those types of actions where the data can be taken outside of things like ransomware attacks. Now, technology is playing a transformative role within mortgage firms, increasingly leveraging artificial intelligence or AI and automation to enhance efficiency, speed, and accuracy in underwriting, document management, and customer service. E-closings and digital loan platforms have gained traction. In fact, it's expected by the 2030, roughly 30% of all mortgages closed will be e-closings. While this new technology is great, lenders need to ensure their tech solutions align with fair lending laws and data security privacy laws. 2023 and 2024 were very busy years in the AI space and still are. Almost every single industry had consent orders levied against them. The FTC brought 21 different enforcement actions against companies ranging from data brokers to healthcare entities. even in the legal field, we weren't exempt. When the FTC brought a case against the company Do Not Pay, they advertised virtual legal consultations using AI. Now, while the FTC was all over the arena, the CFPB also brought consent orders continuing their targeted reviews of AI algorithms and that unintentionally led to discriminatory underwriting practices and discriminatory advertising. As mentioned, remote online notarization is continuing to revolutionize the closing process, but it's not without risks either. Again, continuing from 2023 into 2024, the CFPB had issued penalties to multiple firms for failing to properly secure digital notarizations, highlighting the need for robust cybersecurity protocols. Now, compliance with both federal and state RON regulations is essential. Lenders must ensure that your tech solutions align with the fair lending laws. Otherwise, you could be risking the same penalties. Consumer privacy, cybersecurity and privacy remain a top concern. Data breaches continue to expose sensitive borrower information, and ensuring compliance with data privacy laws like the GLBA or Gramm-Leach-Bliley Act and CCPA is crucial to avoiding those costly penalties. Federal laws on consumer data privacy and data security cover various industries and individuals. Financial institutions are governed by the GLBA, and that GLBA has gaps for different aspects of information security. To cover those gaps, there are over 50 different non-federal data breach laws throughout the United States. Multiple states have even enacted task force operations. In California, the state had passed the California Consumer Privacy Act, one of the strongest state privacy regulations in our nation, and following in the footsteps of the European Union's General Data Protection Regulation, the CCPA's aim is privacy control and transparency in data practices. Now, the CCPA declares that the right of privacy is an immediate or is an inalienable right, and fundamental to privacy rights is the ability of consumers to control the use, including the sale of personal information. While the CCPA only applies to residents of California, lenders nationwide will feel the effects of the new law. More states are passing similar legislation as well. So the big question that lenders really should ask, is there a legitimate business purpose for retaining the information? A business or service provider shall not be required to comply with a consumer's request to delete the consumer's personal information if it is necessary for the business or a service provider to maintain the consumer's personal information in order to complete the transaction for which the personal information was collected in the first place, to provide a good or service requested by the consumer or reasonably anticipated within the context of a business's ongoing business relationship. Now, less data retention, not going beyond your regulatory retention requirements, equals less exposure, which, of course, is adverse to many of the newer technologies such as AI and machine learning that really rely on data to process this information. Fannie Mae has instituted stricter cybersecurity protocols where sellers and servicers must now report any cybersecurity incidents within 36 hours. The updated Information Security and Business Resiliency Supplement outlines these requirements now with full compliance that is expected by August 12th of this year. Now, this move really underscores the importance of safeguarding borrower information and maintaining system integrity. Most of the states have their own statutes and timelines for cybersecurity incidents, but previously, state requirements were typically more stringent, and this change will require lenders to review your policies and procedures surrounding information tech, business continuity, and data breaches in general. Rising interest rates and market volatility. The shift towards non-QM and ARM. Now, 2023 had laid the groundwork for 2024 with high interest rates and inflation. And the combination of persistently high rates and elevated property prices really challenged homeowners, home buyers, and lenders alike. Mortgage brokers and lenders had been forced to continuously adapt in order to maintain competitiveness. And then back in 2024, it really introduced new dynamics that required brokers to embrace innovative strategies, alternative loan products, and client-centered solutions. In 2025, this year, housing affordability and demand has continued to vary widely across U.S. regions, and these regional housing trends prompted mortgage brokers to adapt their strategies in response to shifting client needs in the market. Throughout 2024 and into 2025, there is still the significant challenge of limited housing inventory and intense competition amongst buyers. Now, national housing supply remains constrained with a shortage of available homes, and despite stubborn interest rates, in most markets, home prices have not yet dropped. This limited supply has created hurdles for many clients, particularly first-time home buyers with limited resources to compete in competitive markets along with interest rates. Now, that being said, we do know that there, and maybe even you would know better in your local markets, there are those markets that are dropping. And, certainly there is a lot of concern about how those prices will stay up there. But again, with the limited inventory, I think that overall, it's probably more localized than national. Now, actions taken in 2025 just further pushed the limitations of the market. On March 2020 or March 25th of this year, FHFA Director Bill Pulte had ordered the termination of special purpose credit programs that were supported by Fannie Mae and Freddie Mac. These programs were designed to assist underserved borrowers with down payments and closing costs, and the termination indicates a significant policy shift within the FHFA. In response to the culmination of factors in 2024 and supported by policy shift in repurchase demands in 2025, both brokers and lenders have started to turn to creative financing solutions, including non-QM or non-qualified mortgage and adjustable rate mortgages or ARMs and temporary rate buydowns. These options are riskier than the traditional fixed rate loan and carry higher interest or higher compliance risks. As with any risky features such as ARMs, balloon payments, the CFPB has penalized lenders for failing to properly disclose risks to borrowers, especially regarding balloon payments and interest rate changes. Full transparency and clear borrower communication remain critical no matter what. Now, the Trump administration has implemented policies barring illegal immigrants and non-permanent residents, including asylum seekers, and in some situations, even DACA again, from obtaining FHA-backed mortgages. And this restriction introduces a new set of challenges in discrimination and fair lending. Speaking of fair lending and UDAP, the Consumer Financial Protection Bureau is stepping up enforcement, or had stepped up enforcement back in 2024 with a focus on fair lending, UDAP violations, and privacy. The consent orders had led to multi-million-dollar penalties, underscoring the need for robust compliance programs across all mortgage operations. Now, affordable housing is more critical than ever, of course, but lenders must ensure that you aren't unintentionally violating those fair lending laws. Back in 2024, several institutions had faced penalties under the FHA for discrimination practices tied to first-time home buyer programs. And staying compliant with fair lending laws is non-negotiable, even if the CFPB is preoccupied at the moment. The states are going to have and are training their sites on fair lending. All right. While fair lending rules and regulations have existed for quite some time, we're starting to see a resurgence of regulators, both federal and state, focusing in on the fair lending enforcement. As such, I want to provide a quick review of fair lending requirements in general. First off, it's important to note that there is no single fair lending regulation, but rather multiple federal regulations and some state-specific regulations that make up a suite of fair lending rules, which collectively prohibit unlawful discrimination. However, from a federal perspective, the two most common regulations are the ECOA, the Equal Credit Opportunity Act, and the FH Act, or the Fair Housing Act. Okay. ECOA's provisions prohibit discrimination based on race, religion, national origin, sex, marital status, and age, as well as discriminating against a borrower based on whether their income is derived from any public assistance program or if they are exercising their right under the Consumer Credit Protection Act. Likewise, the Fair Housing Act prohibits discrimination based on race or color, national origin, religion, sex, family status, or handicaps. Another regulation that is heavily involved in fair lending compliance is the Home Mortgage Disclosure Act, or HMDA, or HMDA. HMDA requires a lender to disclose information as gathered about applicants, including race, ethnicity, and gender. And the HMDA filings are actually available to the public, and the data in the HMDA filings can be used not only by regulators, but by private parties to perform fair lending analyses to determine if lenders have potential redlining practices that violate the fair lending regulations. Now, as had been a trend throughout this webinar, it's important to remember that states can and often do have their own fair lending and anti-discrimination regulations that may go above and beyond what the federal regulations cover. For example, many states now expressly prohibit discrimination based on sexual orientation as well. Finally, as part of this overview, it's important to remember that fair lending violations can be, and typically are, unintentional. There are three main fair lending violation types, and that's overt discrimination, disparate impact, and disparate treatment. In the disparate impact and treatment categories, it's often the case that the policies, procedures, or practices carried out by lenders or their employees unintentionally result in protected classes being treated differently and unfairly by the lender or employee. Now, keep in mind that your best intentions will not exempt you or excuse you from fair lending violations. This is why you must review your pricing strategies carefully to ensure you do not unintentionally have a disparate impact. Now, all lenders should have an established fair lending program. That being said, as is the case with compliance management systems in general, a fair lending program can and should be tailored to the size and complexity of the lender's operation. Listen, a small lender will not be able to support or be expected to have the same complexity in fair lending programs as a national top-tier lender. But that being said, there are many elements of a fair lending program that a lender of most sizes can implement in order to help ensure their compliance. And this include comprehensive fair lending training for all staff. It's important that all employees are aware of their role in ensuring all borrowers receive equal access to credit. We always recommend that a lender have clear underwriting and credit guidelines that are easily accessible by all underwriting staff and employees in general. It's important that these guidelines clearly support equal access to credit and do not contain any discriminatory stances or language. So while some lenders, they simply adopt the GSE agency or investor guidelines, it really is important to note that if you have any overlays, that they are clearly published and documented. And this will help you ensure that your credit box is applied equally to all borrowers. We also always recommend a second review, or two to say no, is performed on all declined loans. Lenders should also have a formal process in place to track and monitor complaints. While this may not seem to be directly related to fair lending, tracking the types of complaints, the sources of complaints, and the loan specifics for each complaint can indeed play a key role in helping to identify a pattern or practice of discrimination that you may otherwise be unaware of. For lenders that reach a certain size, it is then important to ensure you have an established and formal fair lending monitoring or testing program in place. Now, as part of the testing program, we generally recommend conducting periodic reviews of pricing and underwriting exceptions, and it's important to have a log for both types of exceptions to make it easy for the audits. Some regulators will ask for this information, especially in a fair lending exam. But for medium to large companies, we highly recommend conducting a formal matched pair analysis. And a matched pair analysis basically takes two loan files with similar characteristics, for example, subject property located in the same state or area, similar loan amounts, employment status, and then compare the terms offered to a protected class borrower and a non-protected class borrower. This will help you identify if borrowers form a protected or from a protected class are receiving loans with higher fees, higher rates, or have a higher declination rate. And finally, we do recommend that lenders of all sizes establish a formal whistleblower hotline or a confidential reporting process. What about UDAP? Well, under UDAP, or under the Dodd-Frank Wall Street Reform and Consumer Protection Act, the Dodd-Frank Act, all covered persons or service providers are legally required to refrain from committing unfair, deceptive, or abusive acts or practices, and these are UDAPs in violation of this act. Often the UDAP is used as a tool by the CFPB when it finds some sort of unsavory practice that doesn't fit neatly into the other rules. For example, let me say, if the CFPB were to find that although a company is paying a loan originator the same comp on every loan, the originator is nonetheless steering consumers into particular loans or loan terms that are not in their best interest sometimes, and the CFPB may look to see whether that practice is unfair, deceptive, or abusive, and whether the company knew or should have known about it. As far as recent cases that show how detrimental these violations can be, well, these I wouldn't say these too recent, but we've got the Wells Fargo one that I do like to point out. And in Wells Fargo, they had settled a major redlining case, or more precisely, a string of the cases that had started all the way back in 2012. What was originally a $50 million fine and implemented corrective actions has now reached $3 billion. And the case involved discriminatory practices in mortgage lending, including failing to market products in Black and Latino communities, resulting in discriminatory advertising and outreach methods. Mortgage lenders must ensure that you comply with the Fair Housing Act in order to avoid, some potentially very steep fines and penalties. There's also the Rocket and HUD case that had settled, where Rocket Mortgage reached a settlement with HUD, agreeing to pay a $12.5 million fine over FHA violations. The case stemmed from improper underwriting practices, including failure to follow FHA guidelines or on borrower eligibility and income verification. Now, lenders must ensure strict adherence to these guidelines and incorporate proper training in order to avoid similar penalties. I can't understate the interest in having you make sure your teams are educated. That's something great to have on your file whenever these issues come up, and could potentially mean the difference for you. Now, there was a pay-to-pay case settlement. Onity and Mr. Cooper faced a collective $15 million fine due to a pay-to-pay lawsuit. The companies were accused of charging consumers fees for paying their mortgages via credit card or automated systems without proper disclosure, violating the Truth in Lending Act. Lenders need to ensure that all payment-related fees are clearly disclosed in order to avoid similar issues. Another pressing issue in 2025 is the growing problem of zombie second liens. These occur when second liens are not properly released after a loan modification or are not properly notified with statements. This could be easily overlooked for loans that are not enforceable until the end of a 30-year fixed, or in partial waivers. But this mistake, based far in the future or the past, comes with potentially big consequences. Now Bank of America had been fined $2 million in 2024 for mishandling second liens, and lenders should ensure you have proper systems in place to track and release liens after loan modifications in order to avoid similar penalties. Marketing service agreements. Gosh, back in the day, MSAs had been a four-letter word. A lot of people didn't think you could do it at one time, and that simply is not correct. But inflation has reshaped mortgage markets. Lenders must really tread carefully when adjusting the products and rates, Misrepresenting inflation impacts in marketing materials has led to regulatory penalties. Transparent, accurate communication is critical to maintaining borrower trust and regulatory compliance. Now, with MSAs, the problem, why it was a four-letter word and why we don't believe it is today or shouldn't be today, is that MSAs had, it's easy to do a compliant MSA. It's not so easy to comply with that compliant MSA. And what the regulators look at is not just what's on paper, but how it's being performed. And if you can't put down a valid MSA that you can adhere to, that doesn't make business sense, well, then you shouldn't be looking at the MSA. But that's really where the rubber meets the road. All right, RESPA. With RESPA Section 8A is the prohibition against kickbacks and unearned fees. In this section, we're going to concentrate on today. We're going to concentrate today on no person shall give and no person shall accept any fee, kickback, or thing of value pursuant to any agreement or understanding, whether oral or otherwise, that business incident to or a part of a real estate settlement service involving a federally regulated mortgage loan shall be referred to any person. RESPA was enacted to eliminate abusive practices such as payment of kickback fees, which drive up costs of production to the consumers. And there are 5 elements that are listed as part of Section 8A, which are the thing of value pursuant to, number 2, an agreement or understanding, refer to settlement services in connection with a federally regulated mortgage loan. It's important to note that an agreement or understanding of the referral of business incident to or part of a settlement service need not be written or verbalized, but may be established by a practice, pattern, or course of conduct. When a thing of value is received repeatedly and is connected in any way with the volume or value of the business being referred, the receipt of the thing of value is evidence that it is made pursuant to an agreement or understanding of the referral or business. And under Section 8C of RESPA, it does not prohibit payments for services rendered or goods facilities actually provided. Good services are actual, necessary, and distinct, and payment must be commensurate with the value of good service. And that goes back to the MSAs. Now, key RESPA terms, additional definitions that are key to understanding RESPA requirements. And I've gone ahead because we are getting really bad on time. I want to go ahead and kind of breeze through this, but you will see the key RESPA terms, and all of this material will be made available to you. And if you're not able to get your question out for the FAQ, by all means, please feel free to reach out to Mimi and TMC, or reach out to me directly, and I'll be happy to get you some supplemental information, as part of this webinar. All right, let's see here. Let's kind of skim along. Okay, so marketing compliance, advertising for mortgage or other loan products is a highly regulated activity. In addition to RESPA, there are multiple other federal regulations that play a part in marketing and advertising compliance. And these include Reg Z, Reg N, Reg B, UDAP, SAFE Act, fair lending, and redlining. And these regulations, create a variety of nuances that lenders are expected to adhere to. Restricted words and phrases, along with buzzwords and trigger terms, are a slippery slope that can really lead to visits from regulators and possible violations. The phrase "I didn't know" is not a valid excuse for regulators. It's also not one for lawyers. So it's worth the time and effort that it's going to take to protect your companies from the fines and penalties that result from non-compliance. Now, getting more into the MSA, which I briefly mentioned earlier, again, the key to compliance here is making sure that you have not only an MSA that is good in writing, but also is good in performance. All right, let's go through. Now, you'll see here, we did list the MSA pitfalls. And let's see, lead generation agreements, office rental agreements. And this is where, the rubber meets the road again with regard to what you have in writing and what you have In actuality, see, gone over affiliated business arrangements, MSA pitfalls, co-marketing, office rental agreements, lead generation agreements, trigger leads. Now, this is kind of a issue that has been on a lot of people's minds. It's been the subject of a lot of lobbying efforts. I have also been involved in some of these efforts. Um, you have the trigger leads, which really involve sharing consumer credit inquiries with other lenders. And legislation had been introduced to prohibit this practice, but the Senate passed a related bill, and I don't know where it stands at this very moment. But states like Texas have enacted laws to regulate trigger leads, and I do know that it is the subject of the ongoing lobbying efforts. We'll see how that ultimately pans out, but it's an easy issue, when it comes to the trigger leads. Regardless of whether you think that's how some people get their start, the bottom line is that it is, in my estimation, bad for the industry overall. Dual employment, dual capacity, and conflicts of interest. Trying to get through this here. I'm going to talk a bit about the dual employment, dual capacity. Although the changes have been in place for some time, we still get a lot of questions about it. And with regard to this change, HUD significantly changed its hardline stance on dual employment or conflict of interest provisions. The rule now states participants that have a direct impact on the mortgage approval decision are prohibited from having multiple roles of sources of comp, either directly or indirectly from a single FHA insured transaction. Now, what's the significance of the change? The modifications both seem to narrow the employees who are subject to the conflicts of interest policies and impose what appear to be more significant restrictions on those employees. The announcement included that participants that have a direct impact on the mortgage approval decision are underwriters, appraisers, inspectors, and engineers. The announcement went on to say that indirect compensation includes any compensation resulting from the same FHA insured transaction other than for services performed in a direct role. Now, some examples of indirect compensation would include compensation resulting from an ownership interest in any other business that is a party to the same FHA insured transaction or compensation earned by a spouse, domestic partner, or other family member that has a direct role in the same FHA insured transaction. Under the modified policies, those restrictions on comp continue to include spouse, domestic partner, or family member with a direct role in the same transaction. Family member is further defined as a child, parent, or grandparent. Now, this may seem like a short list, but that list also includes step relatives, foster relatives, adopted relatives, or adoptions being placed by an agency. Actual definition reads like a laundry list. Now, I'll let you go through. I provide these lists so that you have the chance to go ahead and analyze that. But moving on to slide 48, prepare. So you may have noticed a few areas of the new guidance that really sticks with you. Now, the participants didn't include the owners. Was that a mistake or an oversight? We don't know, but it seems unlikely that regulators consider inspectors to have more influence on loan approval than owners. The list of associated family members includes family of the borrowers, and this deviates from RESPA that says borrowers can't be perceived as receiving kickbacks since they are a party to the transaction, but now their family members are a source of indirect compensation. In addition, the existing policies addressing comp for underwriting and QC staff, the reporting structure for underwriters and conflicts of interest for home equity conversion mortgages, remains unchanged. FHA lenders, really should take a careful look at the parties subject to the new policies or that could be subject to the new policies in order to assess if any changes in operation are going to be needed or appropriate. All right, let's look forward at this evolving role of the CFPB. Although the new administration leaves questions to be answered, the CFPB stepped up enforcement in 2024 with a focus on fair lending, UDAP violations, and digital privacy. Recent consent orders have led to multi-million-dollar penalties, underscoring the need for robust compliance programs across all mortgage operations. In addition, while the CFPB continues to reiterate its importance and regulation, individual states have stepped in and stepped up to maintain or even ramp up their exam processes. New York, Massachusetts, New Jersey, Pennsylvania, and California have all launched a mini version of the CFPB designed to pick up the slack in areas they perceive the CFPB as not being proactive. And many other states have legislation to do the same in the works. The states, will establish their own definition of what is or is not proactive enough, and it's not necessarily a good thing if the federal government takes a back seat. As I mentioned at the outset, it incentivizes states to enact their own governing body or regulations, creating a much greater deal of inconsistency in legislation from state to state, all of which you may very well need to comply with, depending on what state you're in. Audit preparation. A review of vendors, internal policies, procedures, and activities in general is essential to your organizations having a high level of audit preparedness. In the mortgage industry, the potential for an audit is often associated with either fear or uncertainty, regardless if the auditing entity is a federal regulator such as the CFPB or a state agency or an investor. The root of an audit is the intent to determine if mortgage companies are complying with the guidelines designed to protect consumers. In addition to the obvious goal of not falling out of compliance, adhering to established policy and procedures practices is vital for being prepared for any unexpected visits from regulators. Just this last year alone, we have been working on audits in Illinois, Washington, Hawaii, North Carolina, where else? California, all across the board. And the differences in them is, truly mind-boggling. Some of the states, it looks like they are on a money grab, my view. And that's how I feel. And when I'm looking at some issues with the DFPI and some of the tactics that I have seen in defending our clients there. Um,
Hi,
so
James. We're at the 1 minute mark. I
yeah,
just need
thank
to
you
give
very
you a
much. And look, my apologies, everyone. Despite my best intents to get through this entire program, you will be receiving a very fulsome PowerPoint. And again, I welcome you to reach out to Mimi or me directly with any questions. Otherwise, Mimi will send me your questions, and I will go ahead and make sure that I prepare the FAQ. But Mimi, thank you so much for doing this with me. And everybody, thank you very much for allowing me the opportunity to present to you today.
This has been a wealth of information, James. Thank you so much for your time, and we appreciate everybody attending today. You'll be receiving a copy of the presentation as well as a recording following this presentation. And James, we appreciate your time in answering the question. I think there are 3 questions that's as
Yeah,
a follow-up. So I will send those to you afterwards.
perfect. Thank you again. And listen, I'll get that out for you guys right away. Thank you, Mimi. Thank you, everyone. You all have a great rest of your week.
Thanks, everyone.